Hi, I'm Jeff Lovell, a staff accountant with AA Accounting, and today I'm going to talk about some common errors I've seen on farm tax returns and how to avoid them. Specifically, I'm going to cover some personal versus business expenses, some issues I see with depreciation, and the question of whether a farmer is subject to self-employment tax. The IRS requires farmers to separate out their personal expenses, which are non-deductible, from their deductible farming cost. An example where this is going to come up as an issue is with utilities. The IRS in the past has required taxpayers to actually have separate utility lines for electric, water, and gas for, say, the barn versus the main house. Another example is you need to keep a mileage log for the vehicles that you use for farming because you can only deduct the mileage related to the farming activity. So you don't want to be deducting, say, your trip to church or the grocery store on your farming return. And then you need to divide up your property taxes, either by having them on separate parcels for the farming operation versus the homestead, or based upon acreage, if it's all on one parcel. Depreciation can get a little wonky, but mainly what I want to focus on here is two common errors I see. The first is having to do with the depreciation method, and the second is the useful life, or how long you depreciate it. Post 1986, farmers have to use the IRS maker's depreciation method for any farming equipment that you put in service on a farm. Some common examples I see errors: farm buildings like a shed or a barn are depreciated over 20 years, not 39, like say an office building or a factory. Culverts and land improvements go for 15 years. Orchards and vineyards are 10 years. And cattle and other dairy and breeding livestock and most equipment goes over 5 years. And those are different for other types of businesses. The other issue you see is the rate at which you depreciate. So for farms, you're capped out at 150% declining balance method. Okay, so you can't depreciate things as fast as you could for other types of business assets. Now, the biggest question for farmers on a tax return is going to be whether the farmer has to pay an additional 15% of their profits into Social Security and Medicare for retirement. You are subject to self-employment tax on your farm profit if either you're a sharecropper and the share of the crop that you get is dependent upon the yield. So this is a situation where the risk is on you and therefore you're considered self-employed. Or if you're the owner of the farm and you rent it to someone else, sharecropping or otherwise, you have to be careful how much involvement you have in the farm. So the IRS says that you're self-employed if you either work 100 hours per year over a 5-week period or longer on the farm, you pay half of the cost of the farming operation, you provide half or more of the equipment and tools, you consult with or advise the tenant, or you inspect the operation, or you engage in managerial activities on the farm. So if you're doing those kinds of things, you're at risk that that's going to be considered your farm, and then you're going to have to pay self-employment tax. And the last thing is, obviously, if you're the one engaged in farming, if you're the one who owns the farm, manages it, etc., and you're doing that with a profit motive, in other words, it's not just a hobby, then that's how you make your living, so you've got to pay into self-employment. If you have questions about farm taxes or any other tax or accounting questions, give us a call at AA Accounting. Call us today to set up an appointment to discuss your tax situation with one of our tax experts. We can help.